Right now, Applied Digital, ticker APLD, is trading at $35.15. That's up about 82 cents or 2.39% on the day. And frankly, seeing that small green number next to its name is the entire reason we need to talk about this company. Because the market's expectation for this stock is completely fundamentally disconnected from the reality of what just happened. Most people trading this on the Robinhood app or looking at their SoFi Invest account see a 2% move and think it's just another day of volatile trading for a company they probably still associate with crypto mining. They see a stock that's whipsawed between $3 and $40 in the last year and assume this is just noise, maybe some carryover momentum from chatter about Nvidia stock or other AI plays. The expectation is that APLD is a speculative bet, a high-risk gamble that moves with headlines. But the reality? The reality is that just 7 days ago, this company announced a deal that fundamentally redefines its entire existence, and the market, with this tiny 2% bump, is acting like it barely even noticed. That deal is a $5 billion lease agreement with a major investment-grade U.S. hyperscaler. This isn't a maybe, it's not a projection, it's a 15-year contract for 200 megawatts of power at its new Polaris Forge 2 campus, all of it dedicated to high-performance computing and AI. This single deal is set to generate $5 billion in revenue, a figure that dwarfs its current operations, and it immediately rockets Applied Digital into the big leagues of AI infrastructure providers. This isn't a crypto miner anymore. This is an AI landlord, and the market is still treating it like a tenant farmer. The disconnect here is palpable. When you look at the common belief, the story that's been baked into APLD for the last couple of years, it's all about its past as Applied Blockchain. It was a company that went public right as the crypto winter was setting in, a company building data centers for a very volatile, very risky clientele. Many investors, particularly those doing self-investing for the first time, got burned on stocks in that sector. So when they see APLD, their pattern recognition kicks in. They see risk, they see speculation, they see a stock that's more gamble than investment. They lump it in with other high beta names and trade it for a quick flip, or avoid it entirely for the perceived safety of Apple stock or broad fidelity ETFs. But that expectation is now dangerously outdated. The challenge to this belief is to stop looking at the old name on the building and start looking at the new tenants moving in. The company's strategic pivot to HPC and AI isn't just talk. That $5 billion contract is the proof. It follows another massive 150 megawatt lease with CoreWeave. These customers aren't crypto startups. They are the backbone of the entire AI build-out. This is the reality. Applied Digital is aggressively transforming itself from a crypto-adjacent host into a core infrastructure provider for the most powerful computing trend on the planet. The fact that the stock is only up 2.4% today suggests the broader market, the algorithmic traders, and maybe even some larger funds haven't fully processed the sheer scale of this change. They are still pricing in the old expectation. Let's look at the recent movement because it tells this story of confusion. Today's volume is already heavy, tracking over 8.8 million shares traded just an hour into the session. This isn't a quiet day. This is an active debate. You have one side, the momentum traders, seeing the stock break $35 and piling in. You have another side, perhaps long-term holders, who are seeing significant insider selling over the last 3 months and are taking profits. That's a real risk to acknowledge. We've seen shareholder dilution over the past year. The company is not yet profitable on an EPS basis. So the bears have a story to tell. This is a great headline, but they still have to build it. It's an execution story, and they're burning cash. This is the tension. On online investing forums and SoFi chat rooms, you see this battle playing out in real time. People are asking, is this the next NVIDIA-style supplier, or is it just another infrastructure company that will get crushed by capital expenditures? The institutions are just as divided. We've got 486 institutions in this stock. In the last quarter, filings show 191 firms increased their positions, but 124 decreased them. This isn't a quiet accumulation, it's a brawl between the bulls who see the $5 billion future and the bears who are stuck on the negative EPS. But here's the detail that cuts through the noise. One of the largest shareholders in Applied Digital is NVIDIA Corp itself. That is the ultimate stamp of approval. The company that makes the chips is an owner in the company building the factories to house them. That's not speculation. That's a strategic alignment. The analyst community is scrambling to catch up, which just adds to the sense that reality is outpacing expectation. In the last few weeks, especially after the $5 billion news, we've seen a flurry of upgrades. Craig-Hallum, Needham, H.C. Wainwright, Lake Street, all of them have reiterated buy ratings and started boosting their price targets. We're seeing targets of $37, $40, $43, and even one as high as $56. Yet, if you look at some financial data aggregators, you might see a consensus price target that is bizarrely low, perhaps somewhere in the 20s. This is a classic example of old data skewing the average. The analysts who are actually reacting to the new information, the new reality, are all pointing significantly higher. This creates a fantastic opportunity for those doing their homework, those using online investment tools or working with Fidelity Wealth Management to look past the headline average and read the individual reports. The market seems to be pricing in the old, stale average, not the new, catalyst-driven targets. This is where you find an edge by understanding that the market's expectation is literally based on outdated math. Sophisticated traders using interactive brokers are likely modeling the execution risk against these new revenue streams, trying to figure out exactly when that $5 billion starts fitting the books in 2026 and 2027. So, what does Applied Digital actually do? It's simple, which is why this is so compelling. They design, build, and operate data centers. But these aren't your grandpa's data centers. They are AI factories, purpose-built for high-density, power-hungry computing. They specialize in proprietary designs, including liquid cooling, which is essential for the next generation of AI chips. They aren't just a real estate company. They are a specialized engineering firm that delivers compute capacity at a massive scale. Their original business, which still exists, was hosting blockchain and crypto mining clients. This brought in revenue but was lumpy and tied to a volatile, very risky industry. The new business, the HPC and AI leasing, is what matters. This involves long-term, 15-plus-year contracts with investment-grade hyperscalers. Think of the biggest names in cloud computing and AI. This pivot from short-term, high-risk hosting to long-term, stable, high-demand leasing is the entire story. The company is essentially building a utility for artificial intelligence. And as we just learned, they've already sold $5 billion worth of that utility's output before the factory is even fully built. It's a profound shift in the business model, moving from speculative revenue to contracted, predictable, long-duration cash flow. This brings us to the future outlook, and this is where the expectation versus reality gap becomes an investment thesis. The market is currently acting as if Applied Digital is a company hoping to land a big deal. The reality is it already has landed the big deal. The question is no longer if they can attract hyperscalers, but how fast they can build for them and how many more they can sign. That $5 billion deal for 200 megawatts came with a right of first refusal for an additional 800 megawatts at the same campus. That is a massive, built-in pipeline for growth. The future catalysts are clear. First, execution. Every construction milestone they hit on the Polaris Forge 2 campus de-risks the stock and proves they can deliver. Second, new contracts. With 600 megawatts now leased, the market is waiting for the next big announcement. Who is the other hyperscaler? And will they sign up for the rest of that 800 megawatt option? Third, a re-rating of the stock. As the market begins to value APLD not as a crypto-adjacent stock with a high price-to-sales ratio, but as a critical AI infrastructure REIT, its valuation multiple could expand significantly. This is what you might discuss with someone providing investment help, or what a Schwab Intelligent Portfolios algorithm might look for: a fundamental change in business quality. But the risks are just as real. This is not a set-it-and-forget-it stock like a broad fidelity mutual fund. The number one risk is execution. They have to build these massive, complex facilities